Let's talk about one of the most important numbers in your entire financial life, your credit score. This one number can affect everything, from getting a loan for your dream home to the interest rate you'll pay on it. So let's get right into how this whole thing actually works here in India.
All right, let's kick this off with a pretty shocking question. Could a simple three-digit number really cost you over 13 lakh rupees? I know, it sounds like an exaggeration, but the answer is a huge, undeniable yes, and I'm about to show you exactly how.
Take a look at that number, 13.5 lakhs. That's not some made-up figure. That is the actual real-world difference in extra interest you could end up paying on a standard 50 lakh home loan over 20 years, all because of a poor credit score compared to an excellent one. We're not talking about small change here. That is a life-changing amount of money.
So what is this incredibly powerful number? In this first part, we're going to decode the credit score, what it really is, and, just as important, who's actually behind the scenes calculating it.
Okay, at its heart, a credit score is pretty simple. It's just a number that falls somewhere between 300 and 900. The best way to think of it? It's your financial report card. A high score tells banks you're a responsible person who pays their bills. A low score, well, it raises some serious red flags.
Now this is where it gets really practical. Look at how these numbers play out. If you're anywhere above 750, you're in the excellent zone. You're going to get easy loan approvals and the lowest possible interest rates. But as you can see, once you dip below 700, and especially below 650, getting any kind of credit becomes way more expensive and honestly, a lot more difficult.
So, who's keeping track of all this stuff? Well, in India, the RBI has given a license to 4 official credit bureaus to do this job. You've probably heard of CIBIL, right? It's the one we hear about the most. Just think of these bureaus as the official scorekeepers. Your banks and lenders report to them every month about how you're doing with your payments.
Okay, so we know what it is and who's calculating it. But what actually goes into the secret sauce? How is that number decided? Let's get into the 3 key factors that make up almost your entire score. It's not magic, it's just a formula.
And here it is. This chart tells the whole story. Look at how much weight is given to just 2 things. Your payment history makes up a massive 35%, and your credit utilization is another 30%. Right there, that's almost 2/3 of your entire score. So let's break these down one by one.
Let's start with the biggest piece of the pie. If you only remember one thing from this whole explainer, make it this. Absolutely nothing matters more than paying your bills on time. Every single EMI, every single credit card payment, hitting that due date is the #1 way to build and keep a great credit score, period.
And the penalty for being late? It's brutal. Just look at these numbers. A single payment just 30 days late can slash your score by up to 80 points. Let it slide to 90 days, and you're looking at a drop of over 150 points. And the worst part? That mistake doesn't just go away. It sticks to your report for 7 long years.
All right, next up is something called the credit utilization ratio. I know, it sounds a little technical, but it's actually really simple. It's just the percentage of your total available credit limit that you're using at any given moment.
The golden rule here, and you'll hear this everywhere, is to keep your usage below 30% of your total limit. Why? Well, think about it. If you're constantly using, say, over 70% of your available credit, it kind of makes you look financially stressed, like you're depending too much on credit to get by. And to lenders, that just screams risk.
The third key piece of the puzzle is simply time. A longer credit history works in your favor. It's like any relationship, right? It gives lenders a long track record to see that you're consistent and reliable. Someone with 10 years of perfect on-time payments is just a much safer bet than someone who only started 10 months ago.
Okay, now that we know what builds a great score, let's flip that around and talk about what can absolutely destroy it. We're going to go over some really common mistakes that people make, sometimes without even realizing just how much damage they're doing.
Okay, let's rapid fire through these 5 big score killers. First, just paying the minimum on your credit card. This is a debt trap, and it signals you might be in over your head. Second, closing your oldest credit card, and we're going to see in just a second why this is such a bad move. Third, applying for a bunch of loans all at once. It just makes you look desperate for cash. Fourth, co-signing a loan. Sure, you're helping a friend, but if they miss a payment, your score takes the hit. And finally, not checking your report for errors. You'd be surprised how often mistakes pop up that could be costing you points.
All right, I really wanted to zero in on this one because it's so counterintuitive. Closing an old credit card feels like being responsible, right? But it's actually a triple whammy against your score. 1, it shortens your credit history.
2, it lowers your total available credit. And 3, because your available credit is now lower, your utilization ratio automatically shoots up. It is one simple action with 3 really bad consequences.
Okay, enough with the problems. Let's talk about the solutions. This section is all about what you can do. This is your action plan, whether you're just starting out or you need to fix a score that's taken a hit. Here's how you can take back control.
If you're starting from absolute zero, don't worry. There's a simple game plan. First, get what's called a secured credit card. It's basically a credit card that's backed by your own fixed deposit, so it's very low risk for the bank. Then, just use it for small, regular things you are going to buy anyway. And this is the most important part. Always pay the full bill on time. Do that for about 6 to 12 months, and you'll be well on your way.
Now, for anyone trying to rebuild a bad score, you have to remember one thing. Patience is everything. There are no magical quick fixes. As you can see here, it can take 6 to 12 months of perfect payments just to go from poor to fair. Getting into that excellent 750+ range is a marathon, not a sprint. It often takes a good 2 years of doing everything right consistently.
So if we boil all of this down to one core idea, it's this. Your credit score isn't just some random number. It's your financial reputation. It's the story you're telling the financial world about how reliable and trustworthy you are. You have to think of it like a valuable asset, one that you need to build up carefully and then protect like your life depends on it.
And with that, we're at the end. So I'll just leave you with this one question to think about. Based on everything we just talked about, what is the very first single step you are going to take starting today to build, improve, or protect your financial reputation?